The share market, also known as the stock market, is a vital component of the global financial system where individuals and entities can buy and sell ownership stakes in publicly traded companies. Investors play a crucial role in the functioning of the share market, and they can be broadly classified into two main categories: institutional investors and retail investors. Investors in the share market. Investors are individuals or entities that purchase and hold shares of publicly traded companies with the aim of generating returns on their investments. Their roles and strategies vary based on their objectives, risk tolerance, and investment horizons. Investors contribute to the liquidity, efficiency, and price discovery mechanisms of the market. 1. Institutional investors. Institutional investors are large financial entities that manage significant pools of capital, often on behalf of other individuals or organizations. These investors include mutual funds, pension funds, insurance companies, hedge funds, and investment banks. Institutional investors play a vital role in the market due to their substantial financial resources and ability to influence prices. Their actions can lead to significant market movements. They typically engage in in-depth research and analysis to make informed investment decisions. Institutional investors often have longer investment horizons and can have a significant impact on a company's governance and strategic decisions. 2. Retail investors. Retail investors are individual investors who trade in the stock market with their personal funds. They include everyday people who buy and sell shares through brokerage accounts. Retail investors usually have smaller investment portfolios compared to institutional investors and might have different investment objectives, including wealth accumulation, retirement planning, or generating passive income. Their trading decisions can collectively impact market sentiment, and they tend to be more influenced by short-term trends and news. Importance of brokers and brokerage firms. Brokers and brokerage firms act as intermediaries between investors and the stock market. They facilitate the execution of buy and sell orders on behalf of their clients. Here's why brokers and brokerage firms are essential. 1. Trade execution. Brokers execute buy and sell orders on behalf of investors, ensuring the smooth functioning of the market. 2. Access to market. Brokers provide retail investors with access to the stock market, allowing them to invest in a wide range of companies and financial instruments. 3. Research and advice. Many brokerage firms offer research and advisory services to help investors make informed decisions. This can include market analysis, company reports, and investment recommendations. 4. Account management. Brokers help investors manage their investment accounts, monitor performance, and handle administrative tasks. 5. Liquidity. By connecting buyers and sellers, brokers contribute to market liquidity, making it easier for investors to enter and exit positions. 6. Regulatory compliance. Brokers ensure that investors' trades comply with market regulations and rules. Market makers and their function. Market makers are entities, often brokerage firms, that facilitate the buying and selling of securities by providing liquidity to the market. Their primary function is to maintain an orderly and liquid market by continuously quoting both buy and sell prices for a set of securities. Market makers essentially stand ready to buy or sell securities at publicly quoted prices, thereby ensuring that there are readily available buyers and sellers in the market. Market makers play a vital role in reducing bid-ask spreads, the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. By narrowing spreads, they make trading more cost-effective for investors. Market makers profit from the bid-ask spread itself and the volume of trades they facilitate. Difference between institutional investors and retail investors. 1. Investment size. Institutional investors manage substantial amounts of money, often in the millions or billions of dollars, while retail investors typically invest smaller amounts, ranging from a few hundred to several $1,000s. 2. Investment horizon. Institutional investors usually have longer investment horizons, as they manage funds on behalf of clients like pension funds or endowments. Retail investors might have shorter horizons, aiming for personal financial goals. 3. Influence on the market. Institutional investors, due to their large positions, can have a significant impact on a company's stock price and governance. Retail investors' impact is less pronounced, but collectively, their trading decisions can influence market sentiment. 4. Research and analysis. Institutional investors often conduct extensive research and analysis before making investment decisions. Retail investors might rely more on readily available information and market trends. 5. Regulatory requirements. Institutional investors often have to adhere to stricter regulatory requirements due to their fiduciary responsibilities to clients. Retail investors also need to comply with regulations but might have more flexibility. 6. Trading strategies. Institutional investors might engage in complex trading strategies, including derivatives and options, to manage risk and enhance returns. Retail investors typically employ more straightforward strategies. 7. Access to information. Institutional investors often have access to exclusive information and research resources. Retail investors rely on publicly available information. 8. Impact on company governance. Institutional investors often have the power to influence company decisions, such as board appointments and corporate policies. Retail investors have limited direct impact on company governance. In conclusion, the share market is a dynamic ecosystem driven by a diverse range of investors, including institutional and retail participants. Each group of investors has its own characteristics, strategies, and impact on the market. The presence of brokers and market makers further ensures the smooth functioning and liquidity of the market, facilitating transactions between buyers and sellers. Understanding the roles of these participants is crucial for anyone looking to navigate and invest in the complex world of the share market.
Thank you so much for watching this video. If you found the information valuable and you're interested in learning more about basics of share market, make sure to hit that subscribe button below. By subscribing, you'll stay updated with all our latest videos and insights. Don't miss out on the opportunity to become a part of our Money Mantra community. And remember, subscribing is absolutely free. So go ahead and click that subscribe button now. Also, if you enjoyed this video, give it a thumbs up and share it with anyone you think might benefit from it. Your support means a lot to us and helps us continue creating quality content. If you have any questions, comments, or suggestions for future videos, please leave them in the comments section below. We love hearing from our viewers and your feedback helps us improve. Once again, thank you for watching, and we look forward to having you as a subscriber.